Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. Last Tuesday, Microsoft announced the takeover of US gaming giant Activision Blizzard, the makers of the famous Call of Duty series and Candy Crush saga. The deal was struck at a massive $69 billion. Microsoft claimed that the pact has made it the third largest gaming company by revenue, following Tencent and Sony. In its official statement, the company also said that the move will provide building blocks for the metaverse. But with metaverse still a distant dream, what is behind Microsoft's ambitious plunge into the world of gaming?
It is not just the players, but gaming companies too are making and breaking records. Grand Theft Auto video game maker Take-Two Interactive announced on January 10th that it was buying Zynga for $11 billion in a cash and stock deal. The milestone did not last long. Just a week later, Microsoft announced that it was acquiring video game company Activision Blizzard for a whopping $69 billion, shattering all the previous records. It is the company's biggest ever buyout and the largest deal ever, not just in the gaming industry, but also in tech. Microsoft will now become the world's third largest gaming company by revenue, behind China's Tencent and Japan's Sony. It is spending an amount that is equal to what it had shelled out on 5 of its largest previous acquisitions combined. Despite the difference in deal sizes, some parallels can be drawn between the back-to-back Microsoft and Take-Two acquisitions. Microsoft will instantly gain a large audience in mobile gaming, where it currently has a negligible presence. Mobile is the largest as well as the fastest growing segment in gaming, and Activision owns mobile gaming studio King, the maker of Candy Crush. Activision's Candy Crush saga and Call of Duty Season 1 are among India's top 10 highest grossing Android games. This will also give Microsoft a major foothold in Indian gaming. Home to more than 430 million mobile gamers, India's gaming market is currently worth $1.6 billion and growing at 35 to 40% annually, with mobile gaming contributing more than 90% to this value. And it will go to the next level after the rollout of 5G services. Most importantly, the acquisition bolsters Microsoft's cloud gaming service, the Xbox Game Pass, which already has 25 million users. The company will gain access to Activision's 400 million monthly active players from 190 countries as it plans to launch Activision games into Game Pass. The Netflix-style subscription service gives its members access to a rotating catalog of games from a range of developers including EA. The games can be played on Xbox consoles, Windows PCs, or Android smartphones. Streamed via the cloud on those devices, Game Pass also supports Android smartphones and tablets. Microsoft has been pushing cloud gaming, where games are streamed onto devices from company data centers but requires a fast internet connection. The acquisition helps Microsoft establish a cross-platform gaming ecosystem. After enterprise software and cloud, Microsoft will also become a formidable player in gaming, regardless of its long-term metaverse plans. Data analytics firm Newzoo estimates that the global gaming market generated $180.3 billion of revenues in 2021. Microsoft's gaming market share is set to go from 6.5% in 2020 to 10.7% when the Activision deal closes. Microsoft said the Activision purchase will provide building blocks for the metaverse or virtual online worlds where people can work, play, and socialize. Its other metaverse projects are taking shape. It has launched its mixed reality headset HoloLens 2, which is now available in India too. This year, it is launching Microsoft Mesh, which lets customers create immersive digital copies of their offices. Some say the world-building game Minecraft, which Microsoft bought in 2015, gives a peek into the metaverse. Microsoft hopes that valuable communities of gamers will help in creating the worlds inside the metaverse when it becomes a reality from just a theoretical concept now.
Not just online gaming, India is one of the fastest growing markets for booze too. Several international brands are testing the waters here. One of them, French distiller Pernod has also big expansion plans for the country. In an interaction with Business Standards, Shurajit Dasgupta, Pernod Ricard's South Asia chief Thibault Cuny talks about his India strategy after COVID restrictions and how he aims to drive in the consumption experience of quality over quantity. Let us join the conversation.
So if you could just go through the changes that you've seen in India and what were the sort of learnings and the changing in strategy that you had to do as a result of that.
Premiumization. And again, as you rightly pointed out, premiumization is definitely something that has happened for quite some time in India. And this is really at the heart of Pernod Ricard. This is what we are known for in the market as well, and this is what we believe we brought as a differentiation in the market many years ago. And India is not an easy market, as you know. Some other markets are much easier. They don't have the same growth. They don't have the same buoyant change and transformations happening all the time. And India is definitely, at the same time, a market that you need to adapt to on a constant basis, and you need to make sure that you have a transformation mindset in your organization because of its fast pace. Our vision was about our role in this market, even if we are starting from scratch, from a small startup, will be to premiumize the alcohol industry for the benefit of the consumer, and with a strong focus since day one on value over volume. As you know, obviously the growth came across, but our main focus was on value. And today we are by far the leader in the value segments where we operate, and whiskeys mostly. And this, considering the scale of India, has been delivered for me with a lot of patience, a lot of consistency in strategy. As we go forward, definitely one of the most recent trends has been more and more acceptance of alcohol consumption, and alcohol consumption at home in particular. And again, as I mentioned, I can clearly see where alcohol stands in society today. It is evolving. There is more and more acceptance, which is important. And we are totally advocating premiumization, but not just for the sake of premiumization. We are advocating premiumization because of drinking quality product is much better. Drinking less, but focus on quality is where we want to bring the experience to the consumers, and that's the most important piece as far as our role in the Indian market.
India is pushing a lot on the whole theme of Make in India, and you have a large number of manufacturing plants across the country. So, what is the kind of divide that you have in terms of volumes manufactured in India versus in the place of origin?
I would safely say that we have probably more than 98% of the products sold in India being made in India. Okay. 98 to 99%. So it's a massive skew towards Indian product or Indian-made product. To say we are definitely much more of an Indian company rather than a French company. In one of our 32 sites, and everything is made by Indians. So that's more about the philosophy. So it's massively skewed towards Indian product. We have the entire process that is made in India. So within the product, same thing, you would have a significant, let's say around the 90+%, depending on the brand, with raw material from India.
So do you also see that eventually you will manufacture wine and gin in India also, rather than importing it?
For sure. No, it's totally part of the agenda, and I cannot give you any timing as far as this is concerned, but definitely it's on the agenda. Gin is easier from a production process perspective, and again, right. We did do it in the past. We just stopped because it's a brand and probably the timing was not great.
If you look at a sort of 5-year period from now, or basically 2030, how big is the Indian market going to be?
So we are number 3 today in the world. So India is our third largest operation as we speak. So it's already pretty sizable for Pernod Ricard. And Pernod Ricard is the number 2 player in wine and spirits. So you can imagine that, yes, it's definitely a sizable operation as we speak. So by 2030, again, we have 2 large players in terms of countries ahead of us. We have the US and we have China. And both of them are still growing extremely well or are already extremely large. So in my view, by 2030, we will be debating around who's number 2. And I expect India to be still in the fight of number 2 as far as our global operations are concerned. Okay, great.
Wonderful.
Thank you very much.
Thank you.
Yes, thank you very much, Rajit. Goodbye.
After Pernod Ricard, let us see what is brewing on the Lal Street. Following a sprint above 18,300, Indian bosses caught their breath last week, rattled by rising bond yields and oil prices. This week, market moves will be guided by Q3 results, F&O expiry, global cues, and budget expectations. Market participants expect the government to retain its emphasis on capex investment with a major focus on growth-supportive expenditures in both the public and private sectors. What else do markets expect from the Union Budget of 2022, and what are the demands of investors?
Amid the raging Omicron variant of coronavirus, all eyes are on Finance Minister Nirmala Sitharaman's 4th Union Budget to be presented on 1st of Feb. The disruptions from the pandemic weighed heavily on India's fiscal metrics last year, with the central government's fiscal deficit rising to an all-time high of 9.2% of GDP in FY21. However, the story changed in FY22 with a better-than-expected tax collection. Subsequently, the deficit this fiscal is likely to be around 6.8% of the GDP. Now, as things look relatively promising from growth perspective, some reduction in pandemic-related spending could be on the cards. Besides, tax buoyancy may further allow the government to go for fiscal consolidation this year. That said, the Indian economy remains fragile and growth volatile. Therefore, markets expect the government to roll out more supportive schemes for agriculture, the rural economy, micro, small and medium enterprises, and social sectors to provide for income generation. But before we get into the details of the budget wish list, let's understand why the onus of the economic recovery could be solely on the government this time.
It is very important to understand that there is no room for monetary stimulus this year. Since inflation is becoming a major threat, central banks will be tightening monetary policy in 2022. The Fed is likely to raise rates by 3 or 4 times this year. ECB also will follow suit. In India, the MPC will be raising interest rates this year. So in brief, there is no room for monetary stimulus. The RBI is not in a position to continue the accommodative monetary stance and monetary stimulus in 2022. Therefore, the onus of stimulating economic growth is on fiscal policy, and therefore the government, through the budget, has to do much of the heavy lifting as far as economic growth is concerned.
As a result, markets expect a substantial increase in public expenditure by the government during Budget 2022. Against this backdrop, Hemang Jani, Head Equity Strategy, Broking and Distribution at Motilal Oswal Financial Services, lists 2 areas that market will eye.
Because of this COVID cases which we've seen in the last, let's say, about a month or so, there is going to be some expectation and pressure on the government to provide some sort of relief package to the most vulnerable sections, particularly SME and restaurants and a few affected sectors. That's number one. Number two is that you have elections coming up in a few states where particularly rural side there has been some stress or some issues in terms of the slowdown and the fertilizers not being available and the slowdown in the spend by the government. So there is going to be that expectation to have some sort of allocation for reviving the rural economy and particularly the agriculture side, fertilizers, so on and so forth. The rest of the focus would be clearly on the industrial growth, how to provide some sort of a momentum to the already stronger economic growth that we are witnessing by having significant reforms, particularly from the corporate sector and the key important industrial segments.
VK Vijay Kumar of Geojit Financial Services also says that along with these announcements, the markets will also eye a clear roadmap for fiscal consolidation.
Another important market expectation is a roadmap, a clear roadmap and timeline for fiscal consolidation. Fiscal prudence need not be top priority in a crisis like the present pandemic crisis. But it is important to appreciate the fact that India's debt to GDP ratio is at 90%, and the centre's fiscal deficit alone is around 6.8%. Therefore, there is a problem regarding financial stability if things go out of control because of some unexpected triggers. We need not strive for a drastic reduction in fiscal deficit, but the finance minister should lay down a clear roadmap for fiscal consolidation, a clear glide path for normalization of a fiscal deficit.
Hemang Jani of Motilal Oswal further believes a clear indication of financial stability could be the only gift to investors this budget.
You have economic growth in place and pro-growth policies by the government, and you don't have any major disappointment on the fiscal deficit or something that would mean that the inflation and the interest rates are going to really run up in a big way. That itself is a decent enough gift to investors, because that will bring in a lot of stability in terms of the stock markets and the way the entire financialization is progressing in this country.
He also believes markets may see a steep rally if there is any announcement by the government that simplifies market participation, provides growth framework and streamlines capital market activity. Coming to the budget wish list, Hemang Jani says investors want reforms for startups and boost foreign investments in the sector.
People are expecting some specific package for the startup and to boost investment, particularly from the foreign investors in the Indian startup ecosystem. So you may expect something on that front. It will not necessarily be in the form of some specific package, but some sort of a tax incentive for investors when they really invest in a startup ecosystem, or some benefits to the founders or people who are starting up, those companies. So there might be something on that front. I don't think having reversed the long-term capital gains tax or the dividend distribution tax, there is going to be any major change, because the government would not want to, make any major changes there, because consistency is going to be important. So we think that, you may expect something for specific this unicorns or startup part per se.
Overall, markets have pinned hopes on the FM to announce a budget that provides consistency in reforms, is pro-growth and assures financial stability in the country.
Markets may well begin the upward movement soon. Let us move on to one of the most debated topics of our times, subsidies. Some loathe it, while others love it. Last week, several top US lawmakers urged their government to approach WTO against India, which they said was subsidizing over half of the value of production for rice and wheat against the WTO limit of 10%. Our next report tells us more about subsidies and why countries need it. Ruling in favor of Brazil, Australia, and Guatemala, which were logged in a dispute with India over its sugar subsidies, the WTO last month said that New Delhi's domestic support measures for sugar and sugarcane were inconsistent with global trade norms. India has now appealed to the WTO's appellate body, claiming that the ruling has made erroneous findings about domestic schemes to support sugarcane producers and exports. Similarly, 28 members of the US Congress have urged the Joe Biden administration to take India to WTO over its subsidies to wheat and rice farmers. Clearly, these countries want level playing field here. But the US and other Western countries are also funneling subsidies to their farmers. WTO allows subsidies up to 5% of the value of production for developed nations and 10% for developing nations. But critics say that the Western countries have long been circumventing rules to fund their farmers. Now reports suggest that in the upcoming union budget, the Indian government will likely earmark 1.4 lakh crore rupees or $18.8 billion as fertilizer subsidy. This is a slight increase from 1.3 lakh crore rupees as fertilizer subsidy in the fiscal year 2022, ending March this year. The subsidy is to compensate fertilizer companies for selling their products to farmers at lower than market rates. The increase in fertilizer subsidy is, of course, being done with an eye on the upcoming state assembly elections in Uttar Pradesh and Punjab. But what do we understand by subsidies and how exactly do they work? In the context of the union budget, a subsidy is a benefit given to an individual, business, institution, or to a particular sector. Subsidies are given to alleviate some kind of a monetary burden and are claimed to be in the overall interest of the public. Subsidies can either be direct, such as cash payment, or indirect, such as tax breaks. The aim is to reduce the price of a particular product in the market, or as in the case of the fertilizer subsidy, to compensate a particular class of producers for selling their products at a price lower than market prices. Another kind of subsidy is the one extended to producers to incentivize manufacturing in a particular sector. A recent example is the Production-Linked Incentive or the PLI scheme for semiconductor goods. Amid the global semiconductor chip shortage that impacted the supply of everything from automobiles to smartphones, the centre sanctioned 76,000 crore rupees for the PLI scheme for semiconductor goods. Under the scheme, the centre will offer financial support or subsidy that will bring down the production costs of companies manufacturing semiconductor chips and thus encourage them to set up new factories and other facilities. As with everything else, there are arguments for and against subsidies. Proponents believe that the government can make use of subsidies to incentivize global companies to make in India and transform India into a manufacturing hub that would ultimately create more jobs. However, critics say that the burden of subsidies falls on taxpayers, who may complain against rising taxes at a time when the economy is not doing very well. Another set of economists believe that while subsidies may help in attracting some companies to set up a manufacturing base in India, the long-term sustainability of such operations would depend more on the ease of doing business here. If a country can provide a conducive business environment for corporations, then perhaps the need for extending subsidies would not be felt. In 2012, the then Finance Minister Pernod Mukherjee had admitted losing sleep over leakage of subsidies. So if implemented well, they can do more good than harm to the country. That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.